the apartment queen on here with us today. Kaylee is going to be talking about all about many different kind of like multifamily commercial options you have when investing with a self-directed IRA. And Kaylee, I'm super excited to have you here today. Before we get started, I do just have a couple of quick announcements for you guys. If you guys have been following us for a while, you know that we host a lot of classes, free webinars every single week. You can find all of these as well as our upcoming schedule at questtrust.com. Click on events, click on webinars. You can RSVP for all of our upcoming events there. But we do have a really big event coming up actually in just 2 days or 2 to 3 days starting this Friday. We have QuestCon Live 2.0. This is a full 2-day online self-directed IRA conference. Tickets are on sale right now. And be sure to lock in your ticket because we do have a virtual networking happy hour for all of our QuestCon attendees. Katie is moderating today's webinar online. We have Haley, Kaylee, and Katie. That's not confusing now. Perfect. But yeah, guys, so Katie is there in the chat throughout this presentation. She'll be posting those links for you guys. Be sure to get your ticket. I do have a promo code for you. If you have not gotten your ticket yet, use promo code Haley30 for 30% off of your QuestCon ticket, as well as the recording if you would like a copy of that as well. But be sure to join us for that event. We have the full lineup online. We are all really excited for it. We've sold close to 300 tickets, so the happy hour should be really great as well. And yeah, that's about all that I have for you guys. Get your tickets to QuestCon. We'll be doing some more events after QuestCon, but this is our biggest thing that we have going on right now. Without further ado, let's go ahead and get into today's presentation. For those of you guys who do not know Kaylee, she is an Aggie. She is awesome. She's a go-getter. And she has found a lot of success in multifamily investing over just the, few short years that I've known you. You've done some pretty incredible things. So I'm super excited to have you here today. If you guys have questions, post them in the Q&A box. I'll come back on at the end and help to answer those for you guys. And yeah, Kaylee, super excited to have you here today. The floor is yours for about the next hour.
Thank you, Haley. I so appreciate y'all having me on, and it's been a while. You'll probably notice a difference in my energy. I've taken some care of myself, and I can breathe a lot better now. So I have too much energy pretty much. So I will try to not talk the entire time and open up the floor a little bit here and there for some questions or Q&A. Let me share my screen real quick and I'll share the presentation that I'd like to show for today. So there's a couple of things that we're going to cover today. And Haley, can y'all tell me if you can see just the screen? Like, for example, I'm going to present right now, so you should see just the presentation in like 2 seconds.
So we can see, yes, we can see the presentation.
Okay, very cool. Yay. Okay. So everybody, I wanted to, obviously thank you for your time, for being here. And then also let you know that there's a couple of shocking facts that I'm going to cover first off before we get going. So there's been some changes as of August 26th, and the accredited definition for investors is changing. It hasn't been enacted quite yet, but it's almost there. I think it will be before the end of the year. So what that means is that the investor pool has now widened for the amount of people that can invest in securitized offerings. So we'll go over a little bit of the history of what that means, a securitized offering. And really the whole crux of the entire presentation is having you understand why they're securitized, what that means, the history of them, and really to get you to the point at the very end where I'm hoping to be able to use my tablet over here and show you a little math workout, what it looks like on a leveraged single family, a unleveraged single family, and what that looks like instead doing it with multifamily investing. You can use your IRAs for any of those types of vehicles, but the types of returns and the types of the ability to not have recourse personally gives you, or is going to be offered to you through securitized offerings, and you can't get that through typical smaller deals, single family joint ventures, things like that. So let's start with a couple of shocking facts after we talk about me a little bit. So this is what it's going to look like. I'm going to swap the networking to the very end of the presentation, but basically we're going to be covering a lot about accredited investors because a lot of people think that they're not, and it's not the truth. The definition is now widened, and then we'll do networking and Q&A at the end. If y'all are new to Zoom, on the bottom here, so if we end up doing a poll, this is where you're going to find polling near the it'll just pop up. And then you have the raise hand if you have something that you want to say at the end. I'll see those on there. And then also Q&A, that's what that looks like. There's a little box. And then, the chat looks like this. So if you want to do any of those things while I'm presenting, go ahead and feel free to participate. The first thing I wanted to talk about a little bit is what is my why? So a lot of the reason why I'm in real estate in general really is and what gets me out of bed every day is my why. So what that is creating independence, financial independence for 1 billion women by 2030. So there's multiple different ways that we're going to do that. The investing part of things in multifamily, that's part of the big picture. But for example, whenever we're doing investments, we're doing them specifically with women operators. So this project I have currently going on right now, the three of us principals are all females. The majority of who has invested in that deal has been females. And I'm also starting a fund and many other things that I won't go down the rabbit hole on, but the point is they're all leading back to that why, creating independence for 1 billion women. So there's so many things that are going to be coming, and it's my pleasure to be able to present and be able to show you guys a little bit of what I know in this realm, and then also be able to familiarize myself with you, because obviously we don't have the ability to meet in person, which is really sad. So I'm going to do my very best to be as open and be able to share who I really am through this presentation. And part of the end Q&A, if anyone has any questions about me as a person or our mission, our company, how we're going to get there, I'm happy to answer those questions as well, not just technical questions about multifamily or securitized offerings. So let's get going. So what we're doing here for 45 minutes is we're going to be talking about recent changes from the SEC, and this makes more accredited investors possible. And again, this is not legal advice. Nothing in this presentation is, I'm not an attorney. I don't intend to be giving any legal advice, but this is just current legislation with the SEC that is not finished or not, it's been published, but it's not enacted yet. So it's in the works. So it was August 26th that this came out, and supposedly within 60 days it is supposed to be the new ruling, and everything is kind of slowed it down with COVID and the election. So hopefully by the end of the year. But the point is you'll get to see how it's expanded, and so it's more inclusive. So here's me. I'm a multifamily principal in 760 doors, soon to be 782 doors, which will be 783 here by December 2nd or so. So we're buying another small multifamily, but we're still growing. I also am a residential real estate broker, so I have a license and a couple of agents, and then former single family flipper. That's kind of where I got into flipping apartments from single family flips. And like I said earlier, I'm an advocate for women's independence and financial inclusion. So much of what goes on in the investing world is very male dominated. And especially for me in the commercial real estate world, it's very male dominated. So that's part of my why, like I said, to bring 1 billion female investors into the world. So that's me. Why are you guys here? So you must keep yourself up to date and educated to make wise investing decisions. If you don't qualify as an accredited investor before and you've missed opportunities, so especially the larger opportunities are sometimes open only to accredited investors, now this may have changed, and I want you to find out how. Alternate asset investing has become more inclusive, like I mentioned, so more investors are going to be able to get involved. And that means that investments leveraged assets are available to more investors instead of legalized gambling, which is what I call the stock market. One thing I wanted to mention as my shocking facts before I really get going into this, I don't know if y'all have been paying attention during COVID to what's been raised out there or what's been happening with different funds or just the general market as far as raising capital right now. And so the reason why securitized offerings are so important is because they're monitored by the SEC. Now, some shocking facts that are surprising because a lot of people, you would think, see a lot of pullback during COVID. And so that has been happening with some buying patterns. But when it comes to there being what we call in the commercial industry dry powder, so money that people are storing on the side, they have in IRAs, they have in different savings accounts, et cetera, that they're kind of saving for a rainy day, right? And so because of that, there's a lot of hungry capital on the side that's losing interest by sitting in those accounts and not being utilized. So one shocking fact I wanted to share with you is that over COVID, twice this has happened. There are a couple of funds in Florida that have raised $1 billion, and these pools are blind, or these funds are blind pool funds. So instead of knowing a portfolio fund where you're able to see what kind of assets are in there, or instead of investing in a single asset offering or entity, these are literally blind pool funds, meaning that the investors have no idea what's in them, and they literally will put forward their capital. And within 2 weeks in Florida, twice over the lockdown, they've been able to raise $1 billion. So I just wanted to put that out there. Shocking fact. And then shocking fact number 2 for us personally, over the entire portfolio, we have had the same amount of collections that we had last year, except for one property where it is 1% below what we normally see. But I mean, right on par with what we're used to. So I just wanted to put that out there because I'm sure there's a lot of fear and I'm sure there's a lot of uncertainty. And so that's just what I'm seeing from our side of things. So just so you know. So why is the SEC, or Securities and Exchange Commission, involved in our deals? So this is to keep sponsors from running away with your money. I want to make that really clear because a lot of people think that the Securities and Exchange Commission is just this big scary entity, and it's meant to, I'm not exactly sure what people think, honestly, but what it's meant to be is to be a securitized place that if, like, literally the sponsors run off with your money and go to Mexico, or they, leave the country and move and never come back, that they'll be able to recover your funds. So really what I wanted to share is that, so when you're looking at different offerings, there are people that put offerings that are not necessarily SEC regulated deals, meaning they're not registered with the SEC under what we do is, I'll explain in a second, 506 rule. But people will see offerings out there that are not securitized, but should be securitized. And I'll explain what we call a sniff test. This has come from another attorney, or I'm not an attorney, but a attorney. Whereas if you're looking at something to invest in and you're looking at it and you see that the investing or the offering is going to be taking money from investors, one, or all of the money is for the same purpose, or 3 is the company/team doing all of the work to make the money. So that's kind of the sniff test of a security. Now, a lot of people will say, okay, well, we only have 2 people on the team. So, and then we have like one guy passively investing, or a couple, or 2 people that are passively investing. But the offering is not registered with the SEC. So that is a security offering. So anything, pretty much what they're looking at right now is anything over 2 or inactive or passive people in the deal. They're saying, okay, this is basically a security. So we kind of err on the side of caution and go ahead, and even though I've done some small deals, register it with the SEC. So just so you know, if you're looking at something that may be structured as a JV or something like that, if in reality the individual is really truly passive on the deal, and it may be structured as a JV, then depending on how many people are JVing together and who's active, it may be actually a security. So just saying that, like, if that operator ends up, like I said, going to Mexico or whatever, there's really no recourse. So just keep that in mind when you're looking at offerings. I lost my mouse. There we go. So this is a pretty cool graph, and I really love to show this to people so that everybody understands kind of where the SEC and these new rules or exemptions that we use, where they came from. So the Act of 1933 is kind of where all of these exemptions started from, and then regulate under this rule of the Act of 1933, Reg D, A, CF, and 3A 11 or 11, Section 11, were enacted. And then under what we do is under rule regulation D, we use rule 506, B as in boy and C as in cat. And both of those offerings are an exemption. So they all mean different things, but just kind of from a 30,000 foot view to understand kind of where things come from, because there's also a type of offering out there that is now expanded to 5 times what it was, regulation CF, which is crowdfunding. So a lot of people ask questions of a syndicate or of me, and they'll ask about crowdfunding, and it's a totally different regulation. It's not the same thing as a Reg D 506 offering. I'm not going to go into all of the others, what a 501, which is before all this, 504, 505 is, but just so you know, that is how we do our offerings. So the difference between a 506B and C is that a 506B is for friends and family. So friends that you have, family members, and C means, and you can't advertise. And then C means that you can take accredited investors only and you can't advertise. With the friends and family offering, we can take accredited and sophisticated investors, and we'll go over in a minute what that old rule meant and what the new rule is. And again, like I mentioned, the history of these exemptions, it was started in 2012 by the Jobs Act, which is Jumpstart Our Business Startups. And then under Title 1, 2, 3, and 4, basically this is the timeline of how all these different offerings are available. So like I mentioned, we are under 506, so Title 2. But that was 506C is new, where you can do accredited, and it's accredited as verified by a third party service that we use. So what is an exemption and why is it used? The reason why the exemptions are used is because, again, we're going to jumpstart our businesses. I'm going to try to move my screen so I can see this. I can't, there we go. But here's the old rules. So we want to jumpstart our businesses and we want to stimulate the economy. And that's why we're basically investing in our own small businesses, is why these regulations are offering. So you guys have heard of a company going public, IPO, you've heard of some, so it's on the New York Stock Exchange and things like that. And so for a while there wasn't kind of an in the middle offering or in the middle way for a smaller business to be able to raise funds legally. And so these have come out pretty much after that point to be able to offer that to friends and family. And like I said, accredited investors. So these are the investor suitability forms that the SEC has published on their website. And so you can look at on the left side here, accredited investors. And then if you roll down, there's sophisticated / non-accredited investors. A lot of the times when I ask individuals what they are you accredited? Are you sophisticated? They go, well, I'm definitely not sophisticated. But the funny thing is that sophisticated actually doesn't mean, is not as stringent, if you will, as it is for an accredited investor. So right here, we follow the 1, 2, 3 rule when it comes to accredited investors. So one, a person whose net worth is $1 million or more, subtracting their primary residence, and that's current. That is changing. 2, a natural person whose income is in excess of $200K each of the most recent 2 years, or jointly with a spouse, $300K for the most recent 2 years. And then it expands to corporation, partnership, LLC, trust, entity, and a couple of other things. Sophisticated really just means, and it says it right here, if you follow over here to the left column or to the right column, that before you're considered a non-accredited investor, the company has to consider the non-accredited investor's company, and it can't consist of a material proportion of his or her total financial capacity. So what that means in layman's terms is that if their investment company, LLC, trust, IRA, whatever they're using, for us, our rule is if it makes up more than 10% of that individual's net worth, then we will not take their investment. So if it's everything they got, not a good idea. The other thing we need to keep into consideration for sophisticated investors is that they must have sufficient knowledge of finance, securities, and investments generally. And then that the investor must have sufficient experience and skill in investments based on actual participation. So again, that has changed. And so we'll cover how that's changed. But basically, these are the old rules. So I'm going to try to move my little screen around so I can keep reading it. But just so you know, that's kind of like the general difference that was the case between accredited and sophisticated investors. And these are the types of investors that can invest in the Rule 506B offerings, both of these individuals. And then in the 506C offerings, only the accredited individuals can invest. So if you didn't qualify as an accredited investor by reading what we just went over before, and you've missed opportunities, now this may have changed. So let's find out. So there's 7 notable additions to accredited investor qualifications listed here under. So this is pretty cool. So if you know somebody who's in good standing with their Series 7, Series 65, Series 82 licenses as a qualifying natural person, they actually qualify as an accredited investor now. So pretty cool. In addition, we have added Indian tribes, or they have, not me, they have added Indian tribes, government bodies, funds, as well as entities under the law of foreign countries that own investments as defined in 2A 51-1B under the Investment Company Act in excess of $5 million. LLCs with a $5 million asset, with $5 million in assets may be considered accredited investors, and add SEC state registered investment advisors, exempt reporting advisors, as well as rural business investment companies, RBICs, to the list of entities that may qualify. So these weren't qualified before as accredited. So pretty cool. Again, expanding it. investments in a private fund, natural persons who are considered knowledgeable employees of that fund now are accredited investors. Kind of crazy. Family offices with at least 5 million in assets under management, as well as their family clients. So kind of like friends and family, but you can bring in their clients underneath that family fund. A spousal equivalent. So this is pretty cool. So I think it mentioned before married or spouse or something like that. But, as we know today, things have changed quite a bit since the last time this was edited, which I believe was 13 years ago. So now a spousal equivalent is also added to the accredited definition, as well as the spouse may pool their capitals for the purpose of qualifying as accredited investors. A qualified institutional buyer, this is kind of old school, this is really not that much new, or that new, but in Rule 144A to include RBICs and LLCs in the event that they meet the 100 million in securities invested and owned threshold in the definition. So these are the 7 new things that have just been added to the definition. So that makes quite, I forget the number, but a huge percentage larger of the American population that's able to invest under the accredited definition. And then again, like I mentioned, this was as of August 26, 2020, and the last change was in 2012. So like I said, this is available now or securitized offerings are available now to more individuals instead of having to go to, like I said, what I call legalized gambling of the stock market. So if you have or have not had a good experience in the stock market, real estate is typically a very good hedge against inflation or deflation or stagflation or jubilee, all these different things that, we're hearing about going on out there, like supposed things that are going to happen. I don't mean to make that comical or funny, but just to say that that obviously real estate is a physical asset that, if we go back to trading chickens and gold, it's something that you have versus a paper asset that, again, can change day by day its value. So that's why I call it legalized gambling. So now y'all can invest. And so with alternative asset investments, you're now able to grow your wealth faster. So you're able to access deals that instead of, I'll go over at the very end here, a little scenario, you're able to access deals that get you better returns than you could typically on your own. In addition to that, without having to do so much work. So you're able to do more of them. So that grows your wealth faster. And like I mentioned, this will grow your wealth faster. Alternative investing with better returns than the typical retirement savings investing, and have the opportunity to have access. I think I mentioned that, secured by real assets. And this will, like I mentioned, come in very handy when you see inflation of the US dollar. And we'll see when this is actually initiated or when this will be finalized, but the SEC, it's not yet. It was supposed to be already. So, so this is kind of my offer to everybody at the end before we do some Q&A. I know that was really short, but I don't want to bore you too much and go into too much of the history and why all the offerings and all the rules have changed, but that's a really good snapshot. So I mentioned the shocking facts in the beginning of how during COVID or how during the lockdown, $1 billion twice has been raised in blind pool funds. I've mentioned how our collections have pretty much been the exact same as they were a year ago over the lockdown. And really now I just wanted to offer everybody that's on the webinar an opportunity to talk with me offline later on if you're looking at evaluating different types of alternative asset investing. So I'm going to try to see if I can flip over to I'm going to have to get out of the screen to let myself come in as I have to make myself I think I have to look at everybody. And I don't know if y'all, like admins that are listening right now, if you guys have access to help me out, because I'm trying to figure out how to swap my screen.
Yeah, I think you should just be able to unshare this screen and then reshare it from the one that you are looking to share. I think.
So I did. Normally I'm used to doing the. Let me go back to Zoom.
Because the other one is on your iPad, right?
Yeah. Normally I do share the whole screen, and this time I did just one screen. the share things usually at the bottom.
Yeah, so I think it popped up to the top. Is it at the top maybe? Once you're sharing?
Oh, there we go. Thank you.
Cool. There we go.
And then make this big. Go to all of our participants. And then I have to make normally I just click on me and I can make myself a oh. It should be under admin, but I don't see it.
I see both of your things here under the panelists.
Aha. Yeah, I don't know how to do it. Usually it's I just right click and then I can do it.
Yeah, I am not 100% sure. Did you want to, because you have some case studies for us, right?
Well, I wanted to basically write out on my iPad or the.
Let's see.
Wait a second. Oh, it's already connected. Okay, there we go.
Perfect.
Cool. So y'all can see it. So let's see if this works. Okay, so what I wanted to show you guys was the difference between if you're looking at different type of alternative assets to invest in. So you can invest in single family, you can invest in multifamily, and that's a good way to segment it. There's so many different types of each kind, but I wanted to show the difference between a single family property that is leveraged and a single family property that's unleveraged as compared to like a current offering that we have, so you can see what's available out there in the world. And there's many other offerings out there, not just ours, obviously. But so, for example, I was on the phone with an investor the other day, and what she told me was she said that basically her house that she put $35,000 down. So she put $35,000 down. And what I want to know is what your cash on cash return is. What is my cash flow? So it's annualized. So we'll set it up like this. I mean, that's kind of messy. Okay, so $35,000 is what she put down in cash. So you want to look at what your initial cash investment is. So then I'm going to do a comparison down here where a personal house that I bought with 20% down. So that was 17,000 ish down. And then what you want to know is what your cash flow is every month, and then what your annualized cash flow is. So for her, or let's just say for me on the bottom here. So for me, I had taxes, I had insurance, and then I had a mortgage that I had to pay. She did not have a mortgage, but she still had taxes and insurance to pay. Now, what this ended up being here for her was about $1,500 a year. And this is a house kind of in the Midwest. And so it's kind of like a lower end house, but I'm going to compare it to a lower end house here. So they're pretty much apples to apples. But the top deal is just cash. And this is with leverage. So meaning that you see that I'm putting less of a cash infusion down. However, it is higher than what it could be. But anyway, so after her taxes and insurance, she's paying $1,500. After she's paying $1,500, but really what you want to see after we do all this math in there is that her net annual profit. So after you get your net, her net annual profit is $1,505. So then that's going to go in this cash on cash formula. That's going to go on the top. And then with mine, so I'm getting basically like $123 a month times 12. So my net profit is $1,476. So 1476. So you can see that they're both pretty similar as far as what our net incomes that we're making from these properties are. When you do the math, her annualized return is, well, let's just do it here. Her annualized return is 4.3% cash on cash return. So that's her cash flow above what is owed, or what she's making above what has either been paid or owed. For me, when you do this math right here, my return is 8.68%. And then again, that's annualized. So much better with leverage than it is with just paying straight cash down, right? So when you're investing in these deals, whether it's single family or multifamily, now you can see the difference between a leveraged and unleveraged asset as far as what kind of returns you're going to make. So just to show you that. So when I'm dealing with a lot of investors that are doing single family, I really do hear a lot of women, especially because we're very conservative when it comes to investing. I've talked to 5 in the last month that have this scenario in the top here where they put a lot of cash down thinking that it's smart, but leverage can be also used against you, not against you. Leverage can also be used to help you be able to do more. So someone that's going, okay, so I'm making 4.3% return. And then you're looking, and this is just a annualized cash on cash return. And so when you're looking at, for example, some of the apartments that are currently out there in our portfolio, one right now is conservatively making 15% cash on cash return year one, 24% year two. So some of the other deals that are out there on the low end, we're getting 9.5%. And there are plenty of opportunities out there that make less cash return. Don't get me wrong. And it's a longer term hold and there's less risk. Again, don't get me wrong. But when an investor is investing in a leveraged asset and it's securitized offering, that investor has no recourse. If something goes wrong with that project, then no one comes after you individually for your assets. Nobody comes after you for it not going well. So whereas if you're doing single family investing for these lower returns, you're also doing all of the work yourself. And then in addition to that, you're personally liable for everything that happens. So I think I just got out of that. Let me see if I can get back to mine. But it just disconnected over here on this end. So let me see. There we go. So we're back. So that was just a little example that I wanted to show y'all looking at a leveraged or unleveraged, leveraged single family asset and then comparing it to some multifamily assets. So in my presentation, I'll just go back to here for some Q&A. And then at the very end, I'll wrap it up with kind of some other offers that I have. So obviously, like I mentioned, that we'll do the 30-minute phone call to talk anybody through where they're at with their investments. So whether you have cash that's locked up in a home, in a non-self-directed IRA, if you're investing in the stock market, you want to compare those numbers. And if anyone has any questions, I am here to answer them. So let's start that now, if that's okay.
Yeah, Kaylee. So I do have a few questions for you. Guys, if you're watching out there, if y'all have questions, be sure to send them to us. But I do have a few for you. Let's see. So talking about if you're an accredited investor, meeting those qualifications, say I'm an accredited investor and I'm going out there and I'm looking for, people to invest with, how do I show them that I'm accredited? What information do I need to have kind of prepared, whenever I'm going out and looking for these investments?
Sure.
Or people to invest with?
Yeah, that's really easy. So if you were, say, for example, looking at one of our prospective investments, we have a couple of people. You always, just like in real estate, you always want to give people like 3 options to call, but really all they are is, and there's if you want to message me, I can send you their information, but really all they're doing is they're talking with your CPA, they're getting a couple of statements, and they're essentially writing you an accreditation letter. That's really kind of all it is.
Okay, nice. Awesome. I've never really known that exact answer. So great answer there. Also, let's talk a little bit about your plan by 2030 to have helped 1 billion women get involved in real estate, and creating that financial freedom. Let's talk a little bit about that. How do you plan on doing that? What do you have going on right now? What sort of resources? Let's just talk about that a little bit. I'd love to hear about it.
Yeah, absolutely. So I didn't jump all the way in because some of it's still kind of in the works. that being the goal, obviously y'all know there's like 7 some odd billion people out there that are in existence, and so everyone's going, oh, a billion, that's crazy. But we're working on what is a key performance indicator of a female investor. Is that, so for example, I'm starting a fund. And the fund it is a female fund. So it's meant as a portfolio fund where females can invest, but also if men want to invest, they're welcome to. But the thing is that the mission behind helping women to become financial leaders in their household is that if the man has a wife or a sister or a niece or somebody in their life that they want to teach what they're doing, that's kind of part of the criteria to be able to invest. They do need to walk them through what they're doing, explain why, and then we have a check-in every 6 months with, I guess, what we call the mentee of exactly what they're doing. So, or they can also invest in her name for her. So for example, if someone has a very young child and basically they're starting a business and the proceeds will be going to their new daughter or something like that. So that's really kind of how that's going to expand. In addition to that, there's a lot of tech that's missing in real estate in general. And there's quite a bit of market share available. So I've got some contacts that we're working on right now. Replacing a few antiquated things that are totally normal in the multifamily, single family, doesn't matter world, but it's going to take a lot of engineering to be able to do that. And so as far as who's going to be doing it, there's going to be female engineers that are going to be designing the software. A female tech fund, so it'll be another separate fund for that project. I've got an app coming out. We're about halfway through making it. And this app, basically you come into the app trying to work on your mindset first, then looking at all the different asset classes that are available that cash flow, looking at pros and cons of all of those, and then after that, comfortable looking at investment documents, and then being able to go into several different portals that exist out there where you can see what all type of projects are available in the real market. So it's not something that I'm doing brokerage or exchanging money in there. It's really just an education platform because in a Merrill Lynch study in 2018, women cited 60% of women in that study cited not knowing enough to feel comfortable investing. However, if you're looking at women who are portfolio managers or hedge fund managers, typically those portfolios perform better than other portfolios that are out there. So a couple of different ways. Yeah.
Nice. That is awesome. That makes me so excited for you. Now, I know last time we had you on, it was, I think in the beginning of COVID. So like 6 months ago, you had a lot going on, but it's really cool to see how it's progressing. Now, and I know you've talked about this a lot and I'd love to hear about it a little bit, but, oh wait, let me get to this question first. Sorry. We have a question from Carlos. This is a good one. Carlos wants to know, I own my home free and clear. It's worth about $400,000. Is it a good idea to do a cash out refi of $250K and invest into a syndication deal?
So that's kind of on par with like legal advice and some other stuff. So I'm not going to shy away from it. I won't say if it's a good idea or a bad idea, but some things to think about for consideration. It depends on what your net worth is. So for us, for example, I wouldn't spend more than 10% of your total net worth. If that is under that amount, sure. But anything, the basic rule is anything that you can't afford to lose, don't do it. However, I have had a few investors that have reached out to me with HELOCs, if that I think is what you're mentioning, that's what they've done. They've pulled some cash out and they're going to live in their house for a long time. So it's definitely something that is being done out there. But again, if it's more than 10% of your net worth, I would consider a couple other options.
Mm-hmm. Yeah, great answer there. And that reminds me, actually, quick plug for Blink Lending. They actually did a really popular Facebook video not too long ago about the difference between a cash out refi and a HELOC. And like, I don't know how these guys have 10,000 views on this video, but they're up there. So Carlos, that's a great video to watch if you want to know the difference between those two. Back to my question that I had. So, and I know you used to like to talk about this a lot up in our Dallas office. You work with a lot of IRA investors. If I want my investment to go smoothly, if I want to, maybe avoid any headaches from the syndicator side, what kind of words of advice would you have for all of the IRA investors out there looking to invest their IRAs into syndications?
So I would say be really clear about what your criteria is, because it's not going to avoid any kind of headaches per se. Whatever happens, and it kind of is what it is. But as far as where you want to invest, because some of that helps to insulate some of the possible issues that will happen. So for example, if you're looking to invest in an area that's landlord friendly, tax friendly, business friendly, and that will insulate a couple of issues that may pop up just based on that market. We're choosing to invest in areas that are another class or two higher than the deal that we're buying. So that way we're kind of insulated by that as well. There's a building that we have under contract now that is all medical professionals. And then there's one person in there that works for the city. So it's people that are not going to leave and they have pretty good security of their jobs. So there's a couple of ways that the market itself and the type of resident makeup of the building can kind of insulate against issues. However, I think there's a list of things that actually I have that my SEC attorney put together. I think it's like 15 different things. And it's just kind of like a general overview. If you're looking over investment documents, always have an attorney do that. I would definitely recommend that. That's probably the first thing I do because, the syndicator or the partner that you're joining up with, cool, but you kind of want to hear it from another perspective as well. So that's probably my favorite thing to do is when they have their attorney overlook documents. And if you're wanting to just take a breeze overlook view of these documents that are pretty thick, it's a 15-point evaluation where you can kind of skim through, look for these 15 things, make sure it's explained very well in there, ask any of those questions if you don't understand to the sponsor, and then, like I said, have an attorney look over your documents. And that still won't insulate you against everything that will happen because, these deals do have risk inherent to them. And that's why I mentioned if you are going to be investing with your retirement savings or pulling out a portion of cash out of your house, just make sure it's something that if something goes wrong, it wouldn't affect your life in a big way.
Yes, another great answer there. So this is my last question that I have, and we'll make sure, to plug your contact information at the end, because I know a few people here want to reach out to you to see maybe what types of deals you have going on right now, but can't really get too far into that here. But before we got started with today's webinar, you were telling me that I think your first deal out in West Texas, I believe, is on the market to sell. Walk us through a bit of that deal as a case study, maybe some things that have contributed to the success of that deal and just kind of, maybe some helpful information about it.
Really, so just like the first 18 unit I was involved in, it was kind of the same type of deal, a different area, but the same type where I'm looking at a building that is a 1978 vintage. It's actually two buildings, but they're close to each other. Where the sellers or the people that own them are mom and pop, or they're not operating it or as efficiently as a business as they can. One of the buildings, they're very different. So in both of those deals, which are now being sold as a portfolio, one was more of a yield play and one was more of a value play. So the value plays are my favorite because everyone says you can't bank on appreciation. They say you can't bank on cash flow. So it's like you can't bank on anything. Well, that's not true. But if you have both, you have one or the other, depending on what the heck's going on with the market or the economy. So the cool thing with a value play, a true value play, there's lots of meat on the bone. You have both the appreciation and the cash flow from those buildings. From a yield play, it's a little bit more of just the cash flow. So it was interesting to see both. One was a lot more stressful. One took a lot longer to renovate and to finish and to turn over all the tenants. One was a lot quicker. In relativity, when you're looking at the amounts that are being made every month, they're pretty similar because they're pretty similar sized properties. But at the end of the day, the big difference, I think, is going to be in the added income that's available to both. When you have like a very virgin and high meat on the bone type property available, there's a lot you can do with it. So you can be really creative. And so you can create more income there, not just decrease expenses. And then you're able to change the curb appeal, change the name, and do quite a bit to change the reputation in the community too. So really, the purchase price of one was $675 and the other one was $547. And let me get my phone real quick to make sure I do this right. I think that's around 20 something K a door. Cause I'll just take the average. So, 675, plus 547, 50. So about 24 K a door going in. And that's including renovations, on both, because we always want to make sure that we can include those in the loan if possible. That way, that money's always there. We couldn't raise it or whatever. You never want to go into a deal, I'll be honest with you, if somebody and you may want to ask this, if you look at the type of renovations they're doing or their pro forma schedule for how they're renovating, if they're basically banking on the cash flow to do the renovations, it's really not a great project, because I mean, it's unpredictable what can happen. And so if it's already built into the loan, then you know that you're going to get that bump in appraised value. So anyway, so we went in at about 24K a door. My assumption based on the market, what had been sold, a few other things, was about 40K a door on sale. The broker is very confident that we're going to be getting between 43 to 45K a door on sale. So then that's based on the bump in cash flow on one and the operations on the other, and et cetera. So basically it's doubling the value, and that was done in about 13, 14 months. So pretty good. And I'm not going to say all the projects are like that in the world. They're really not, especially when we're moving now towards a larger city where the market's not as risky now, but they're not as good at deals. So you kind of have to, do you want the risk and do you want the cash, or do you want, so yeah, the first couple deals were pretty risky, but they've turned out really well as far as like operations go and as far as the deal itself. So now the cash on cash return, et cetera, is not, like I mentioned, 14, 25%, like it is on those ones. It's more towards like 10%, which is still pretty freaking good. But anyway, there's a little more security, I think, for some people in a larger metro statistical area, or MSA, as we call it, Dallas Fort Worth.
Yeah. Wow. I don't understand how you give so much information in such a little amount of time. It's always so great to hear how your brain ticks. It's so intriguing to me. But you said something really interesting there. And, in my mind, I'm thinking I want to bring you back for another class to kind of walk you through those like 15 points that you were talking about, because, those investment documents are long. Not a lot of people read them as deeply as they should. And it is so important, especially when you're investing with either your own funds or your retirement funds. But I love that little nugget that you threw in there about, if they're banking on the cash flow for the renovations, might be something to watch out for. That's definitely a great point to hit on there.
Because
do you have another question here yeah, go ahead.
I was going to say, so on those projects, the DSCR, or debt service coverage ratio, lenders typically require 1.25% spread, if you will, like above what your debt is. So there's like some room that if our rents go down or if our vacancy goes up, we do a stress test of about 20% delta or 20% spread. So that deal was over 2 debt service coverage ratio. So it really beat, what it was supposed to be. And then, what I'm doing now is 2.24% above the required DSCR, not above, but it is, anyway, that is the debt service coverage ratio. So that's another thing, because what happens on those deals where they're renovating with the cash flow is what happens if there's no cash flow. You can't renovate. And if you can't renovate, I've lived this myself. If you stop renovating, sometimes like over COVID, for example, I continued to do things and pay people and hire more people because we could. But if you stop renovating, the rent bumps that we are going to want to get over time would be impossible without doing those renovations. So.
Mm-hmm. Yes, great information. We do have just one more question here from one of our attendees. Carlos again wants to know, has your value add properties been affected by renter non-payments due to COVID-19? How has it affected your cash flow and projections?
So Carlos, that's a good question to ask, because of course a lot of people have been affected, especially on the East Coast and West Coast. And everybody in between. But honestly, I think that the answer to your question, first off, is no, it really hasn't. I mean, the only thing that it's affected is like we need to be more creative with the way that we work with our tenants. So for example, instead of saying, okay, all of your money is due by the 3rd, on the 4th, you have a late fee, and then we're going to yada, yada, yada. We're like, okay, well, instead we're going to say, okay, by the 1st of the month or 5th or whatever it is, half of your rent is due. And then we just are able to work with people, because we don't want long-term tenants that have been there a long time to be kicked out, or for them to have any kind of bad marks on their record or anything like that, or for collections, or to have to leave just simply because things are tight, and that's okay to be a little more flexible. So being proactive has been, I think, a really big strength of every single project we're involved in, no matter what market it's in. But the only property that we've had a lower collection on for a time has been 1% below what it was last year. So across all of the portfolio, I mean, really, the money may not be coming in, right before the 15th or whatever, but at the end of the month, it's all there.
Mm-hmm. Nice. Yeah. And that's a really common thing that I've heard from a lot of people, communicate with your tenants, keep those lines of communication open. Definitely one of the best things that you can do there. Kaylee, this has been so great. So much great information offered today. If someone wants to reach out to you, if they want to know about what you have going on right now, how to learn more from you, deals, things like that, what's the best way for someone to reach out to you?
So you can email me, admin@theapartmentqueen.com, or check out our website, www.theapartmentqueen.com. We also do, on the 20th of November, have a generational wealth summit coming, where we literally have speakers that take you from, and Quest will be there, speakers or that take you from credit building, reporting, all the way through starting to do your first investments, all the way through a family office, being able to build your own. So that's coming up on the 20th. For this week, we have a $50 off coupon. I'm going to give you a private discount code. So do email me, admin@theapartmentqueen.com, and I can get you hooked up with that code, because I'll have to create it. It'll be Quest something. I'll figure it out, but just email me. And then, like I mentioned, we will offer everybody a 4-prong approach to wealth building, a free 30-minute consultation. So if we want to go through like the home values that you have, or other single family assets, or kind of where you're working with, and to get to your goals faster, how to build up to that. So feel free again to email me, admin@theapartmentqueen.com, and we can set that up. I'll send you a calendar link, make it real easy. And then to answer, I forgot to answer the second part of Carlos's question about cash flow projections. So the way COVID's affected our projections when we're putting in offers. So I'm second best and final on another deal right now in Plano. So with each offer, we tell the brokers, hey, we're going to assume for 12 months or for a year, there's going to be no rent growth, because we really don't know if there's going to be. We don't know with COVID what's going to change. So we just assume zero. So, or very minimal, $10, like very small rent bumps, just to take care of some deferred maintenance. So we've been very conservative when it comes to projections, and not even actually keeping up with inflation when it comes to rent increase. So, because we just don't know. So there's that answer.
Yes. Awesome. Guys, be sure to reach out to Kaylee. Again, that email is in the chat. It's admin@theapartmentqueen.com. She's got a lot of great resources for you. So be sure to go ahead and reach out to her after this class ends. Kaylee, before we sign off for the day, do you have any last kind of closing thoughts, closing statements for everyone out there?
Just kind of that shocking fact that I started the presentation with, that it kind of blew my mind a little bit, that there are blind pool funds out there in Florida, a very conservative state, raising $1 billion each time they're doing a new fund, blind pool, where the investors have no idea what kind of an asset it's even going into, or what kind of a business is being purchased with their money. So you have an opportunity to be involved with real estate and be involved with different asset classes through Quest, and through your IRA, self-directing that, to be able to actually see what type of investments you're investing in, and be able to make great returns. So that's the last thing I got.
Awesome, Kaylee. Thank you so much, guys. Thanks for joining us today, everyone out there. We will be sending out the replay. You can also rewatch today's entire class on Facebook as well. If you have questions about opening up an account, attending QuestCon Live, reach out to us. I put our contact information there in the chat. Kaylee, it's been great to see you. Hope you're doing well, and I'm sure I will see you later in another one of our classes here in a few months.
Absolutely. Thank you, everybody, for your time.
Bye, everyone.